They say money doesn't grow on trees, but lately I feel like the price tags are growing on the trees. Welcome into the show. This is the Retirement Compass radio show with Stonebridge. Stonebridge Wealth Systems, Jackie Selby on this side. Gosh, I can never get you guys to laugh at my half jokes. I've got Mr. Gove there in the Kearney office, Jeff Gove. Is that your first name?
Is Jeff my first name?
Yeah, I never get to call you Jeff. I call you Mr. Gove.
Sure is.
Why did I start that 2 years ago? I don't know.
I don't know.
We got Mr. Kulhanek in the Lincoln office. Tim, how are you?
Yeah, Tim is my first name, and I'm doing quite well, thank you.
Is it your real name, though?
Timothy.
Timothy?
Okay.
Yeah.
Timothy is sporting a beard lately. I quite like it. Did you just get tired of shaving last ski season, or?
No, give the ladies what they want, you know? And by ladies, I mean my wife.
Okay.
And the little girls.
And the little
Do your
girls.
kids like it?
Yeah, except the little one, she got those freaking pinchers. She grabs onto it, and it's like, my gosh. I got to use some sort of special technique, to get her grip open, because she's got kung fu grip.
Oh, the little thing.
Yeah.
Well, the two of you, it's great to see you both, and I thought we could talk about this economic shift. Is that what we're calling it? You can't call it a contracting economy. You can't call it a bear market. I don't know. I was listening to our show from last week, Tim, and we were talking about how many bear markets occur in every 3 years. Is that what you quoted me?
About every 3.3 years. And what did you say? How did you define a bear market again, Jackie? Should we go over that again for Jeff?
Oh,
so he
my
understands?
gosh.
That was a few weeks ago, wasn't
it? Yeah. Did Jeff miss it?
Were you here for that, Jeff?
I don't know.
So a bear market.
Give me a refresher.
Oh,
yeah.
gosh.
Would you like to say, Jackie, or should I?
No, go ahead. You can make fun of me. Go ahead.
So the bear market, the reason they call it bear market is because when a bear claws you, they claw down.
Right.
And get you with their and then
right.
Slashes the market down.
Mm-hmm.
It's
and
science.
a bull market.
The definition?
That's
yes,
what Wharton, I think, and MIT have defined it as.
That came out of the Wharton School.
Yeah.
And then the bull market is they hook them with the horns and fling you up.
We don't ever say, hook 'em horns on this show.
I know.
Yeah,
I'm sorry about that.
My kids are really good at doing horns down, just so you know.
Come on, Jackie.
Oh, dear.
This is Husker Nation right here.
I apologize. So they hook your clothing with the horns
They
and
gore
fling
you up.
Yes, they buoy you up.
Yeah.
Maybe. Well, that's my impression of the two markets. Do you think that we're truly in a bear market right now, Jeff?
Well, it doesn't really appear that we're in a bear market. When you look at what the market's doing, what is interesting though is how sensitive, when we're looking at the stock market specifically, how sensitive it is to the news. Mm-hmm. You get a little bit of bad news, or tariffs on every country. Mm-hmm. That's a little bit. The market goes down 10%. You get a little bit of good news mixed with some bad news. The tariffs on China were increased, but there was a pause on the rest of them. Then the market shot up 10%. So it's very reactive right now, and that's why, with all of my clients, and Tim and I did a video that we sent out to our clients a few weeks ago, just on the idea of we have a plan, let's stick with the plan.
Good.
Taking opportunities when the market's down. Adding money to the market, doing Roth conversions, lots of different things that you can do to capitalize on a down market. But the fact of the matter is, if we're looking at a 4% decrease in the S&P 500 or 5%, mm-hmm. if we can't tolerate that type of loss, then we have no business being in the market in the first place.
I feel like that's me. I don't want to incur any loss, but I'm in the financial red zone.
Yeah, financial red zone, which is we call it the retirement red zone.
Fine.
Which there was an interesting piece I saw yesterday, and a lot of how your retirement might go. A lot of it is timing, and it's not something that you can control. It's just kind of when you were born. So if you look at people who were born in the 1940s, for example, they had massive appreciation that they experienced in the S&P 500. Those in the 1920s, not as much, but a lot of it has to do with the 20 years leading up to retirement. And we focus more here at Stonebridge on that like 5 to 7 years before and 5 to 7 years after your target retirement date. Now, you guys are talking about like some definitions. So let's take a step back and like we throw these terms around. So what is a bear market? Let's go over that real quick. So bear market is a decline. The market has to sustain experience a decline of 20% from a recent high. So the last market high for the S&P 500, for example, was February 19th, 2025. And, I don't think it technically entered a bear market. It was like a stone's throw away from 20%. I think it was 19% was the max drawdown so far this year. That's pretty common. The average max drawdown going back to like 1950 is about 14.1%. Now, on the other hand, the NASDAQ, I think, did have a little bit of a decline of 20% because but here's the thing. You have to look at, when is a bear market over, right? And since it's low, like as of yesterday's close, it says, I'm looking up the data, it says that it's had about a 20% rebound from the April low. So, a lot of these, what we've experienced recently have been what we call V-shaped recoveries, where you've got this sharp leg down followed by a sharp leg up. Now, this is a little bit different because people need to understand that the stock market is not the economy and the economy is not the stock market.
But people think this.
What drives the stock market is more like investor sentiment and the volume, essentially. Like it's supply and demand. If more people are buying, prices are going to increase. And if more people are selling, prices are going to decrease. That's all the more complicated it really gets. Now, unfortunately, most investors use their emotions to decide when to buy or sell, which is why the average investor, according to the Dalbar quantitative analysis of investor behavior, I mean, every year this report comes out, every year the results are the same. It's pretty consistent and disappointing year in and year out. The average investor is going to get half or less of the return. If they're investing in stocks, they're going to get half or less in the return of the S&P 500 or the benchmark they're trying to target. And the average bond investor, same thing. So it doesn't matter like what the asset allocation they're trying to target. They just do really, really bad typically. And it's investor behavior. Now, on the other hand, you're also talking about the economy and are we in a recession? And like that's, again, kind of a moving target because there's different definitions. There's like an amalgam of definitions of what that really means. It used to be that if there's two back-to-back continuous quarters of decline in GDP, so back-to-back negative quarters of GDP, that was like kind of the layman's definition of a recession. Well, then that happened, I think 2022, was it, Jeff, that occurred?
Yeah, I think so.
Yeah, and they said, well, but technically no, because there wasn't, I can't remember what they rationalized why it wasn't. I'm not here to defend or support that position. I'm just saying we have had a negative quarter of GDP. That's a fact. But like anything else, you kind of have to lift the hood up and look to see how the engine's running. Because like you could have a situation where, it could be a timing belt issue. It could be that you need to replace the entire transmission. So like where are we at with the economic data? And I'm looking at it right now. So this is from the U.S. Bureau of Economic Analysis. And real GDP was negative, but it was entirely driven by two things. And one in particular is imports. So the way GDP is calculated, they're going to look at net imports, exports. And exports were actually positive, right? So we had more exports than we did the previous quarter. But imports were like crazy high, right? So why do you think, Jackie, there were so many companies importing product to the tune of like that subtracted about 5% from GDP? Why a 5% increase, I should say. So why was there so many companies with these massive imports in the first quarter?
Trying to get everything they could before the tariffs went into effect?
Exactly. They were front-running tariffs. And so if you take that away and you look underneath the hood, it's like, well, consumer spending was up. That's the main thing that's going to drive the economy. Business investment was actually way up. Exports were positive. And so the things that were negative, that were the detractors from the GDP number, was government spending. A lot of it had to do with some of the cuts we've seen so far with the new administration. And that massive imbalance between imports and exports, just the fact that while we were exporting goods and more than we did before, we imported a lot more, which is going to more than offset the positive number from an export perspective. So, like, I'm not telling you that the economy is in great shape, because obviously there's been some challenges we've had. I think housing has really slowed down. You see people struggling to keep up with their 6.875% mortgage rates. Zach, I'm looking at you.
Uh-oh.
But, that starts to wear on people. It's kind of like almost like a stress fracture, if you will, where you could take a dowel and you rub a piece of sandpaper on it, continually. It might not break right away, but eventually you're going to wear that down to the point where there's going to be some fracturing. And I think we've seen that a little bit. But also, I don't think it's something that we can point at and be like, oh my gosh, the sky's falling.
Mm-hmm. Well, at the same time, with imports being higher, even with tariffs coming, companies aren't going to import a bunch of goods that they're going to let sit on their shelves for an eternity. Mm-hmm. So, from a consumer standpoint, I mean, you could look at that as a positive that, these businesses are willing to spend the money to get products in because they're pretty sure they're going to be able to sell them. So, yeah, the other side of it could be good too.
Mm-hmm. Well, I'm going to give your phone number here and encourage folks to contact you guys, 866-295-5146, 866-295-5146, to reach Stonebridge Wealth Systems. And they can help you regardless of where you are in the Midwest. They've got offices all over Nebraska, but not just limited to, also in Sioux Falls and northern Kansas, etc. So please use the phone number, 866-295-5146. And I want to talk a little bit about where the Barbie dolls fall into this whole thing. Are we going to call this the Barbie doll index? Coming up on Retirement Compass Radio Show.
Is your retirement being eaten up by financial termites like hidden fees, inflation, and avoidable taxes? Call today for a complimentary financial review so we can help you root out these retirement killers.
Retirement Compass Radio Show with Stonebridge Wealth Systems. Reachable on this 866 number we have rigged up for you. And this will come into the main Kearney office, but wherever you would like to be seen or place an appointment or have a sit down. What do you call it? Appointment sounds so serious. 866-295-5146. 866-295-5146. What do you think, Tim, that couple that came to sit down with you, were they coming in for an appointment, a get to know you? What did you call it?
The one I was telling about before we started the show?
Yeah.
Yeah. So they came in through the radio program that we're doing right now.
Super.
And, we just call it a complimentary consultation. I mean, the thing is, you can call it what you want. You call it a strategy session, a complimentary consultation, a complimentary second opinion, where you'll receive your complimentary written income plan. The bottom line is you're coming in to, get a checkup from the neck up. You want to make sure that what you're doing, right, the path you're on is the right path and that there's nothing that you're missing. Like so many people when they come in, Jeff, you probably get this too, they say, look, I want to make sure, I don't want to have a situation where I look back 5 years from now or 10 years from now and say, I wish I would have known about this sooner. Because guess what you think a lot of people say when they come in, and they might have $1 million, $2 million in retirement, and 95% of it is in a tax-deferred account, and here they are with this growing, building, ticking tax time bomb they don't know how to diffuse, and they say, Tim, I wish I would have done this a long time ago. So, okay, well, let's prevent that by calling today, right? That's the whole idea of the show, the TV show, you name it.
Mm-hmm. Again, on the number 866-295-5146, 866-295-5146. And I'm not sure I ever, until I met you guys and started working with you, considered my 401k to be a ticking time bomb. But it is. Tax time bomb, isn't it?
A little bit, yeah. I mean, I'm looking, I can see where I sit when we record the show, I can see into my main conference room with that big, beautiful table brought to you by Rastus Snow of Native Sawmill and Lumber Company out of Litchfield, Nebraska.
Yay.
Is he paying us, Jeff? I mean, for this promo stuff? I mean, come on.
I should at least get a discount on the table.
The
he's
new
creating
table.
for me.
Something should be happening here, Rastus. But honestly, like that's the one thing I get the most comments on when people come to this office. It's not the sweet studio I've got. They're like, well, how about this table, actually? I want to take a look at this. Did you build this? And from now on, unless there's an NIL deal that's inked, I might just be like, yep. Well, how'd you do it? It's secret.
Yeah.
Can't tell you.
Well, it's nice to have a showpiece. I know that it's a magnificent table, and he used the resins. He's an artist, right? He procures the wood, right?
Yeah.
And then
it's actually really cool. You get to go to his place, and maybe this isn't for everyone, but we got to go to his place and actually pick out the wood that we wanted to use.
Wow.
So if anybody comes to our Kearney office, our new office, the front desk he did for us, and it had this cool crack down the middle, and he filled that with a clear epoxy, and so you can see down through it. It looks awesome. He did a really good job. So come on in and see if for nothing else, see the stuff that Rastus did.
Well, yeah, it's fun to have centerpieces if they're not interested in audio production. In the Lincoln office there, Tim Kulhanek, they'll certainly look at your table.
They will.
By the way, when does the new office open in Kearney?
Hopefully we'll be in there, I'll just say June 1st.
And it's a pretty visible location, yeah?
It is, right off the interstate.
Good.
Can't miss it.
Can't miss it? Can't miss the big sign, or are you going to build a stone bridge?
Like to the interstate? We should, but the Department of Roads had a problem with that. It's right off the exit. So,
great.
As you're coming into town, you look to the east, and it's right there.
Fantastic. Stonebridge Wealth Systems bringing you the show. And if you do have a ticking tax time bomb called your 401k that just keeps growing and growing, and you haven't really had a consultation or a second view, maybe you're working with someone now, but they've not said to you, hey, listen, this thing's ticking and ticking and ticking. We need to do something because otherwise you're going to have this tax bomb. Then call the fellows at Stonebridge. It's a really easy thing to do, and it's a free consultation. Again, 866-295-5146.
Jackie, if you don't know
yes,
if you have a ticking tax time bomb, go to stonebridgetaxbill.com and find out for yourself.
There you go. Thank you for mentioning that. I needed to bring that up in my mind, but I didn't, so I'm glad you did. It's stonebridgetaxbill.com, and you don't have to have an appointment to use that website, by the way.
You're going to want one after you use it.
Yeah, that's more importantly. Yeah. Well, I was just thinking that, all this tariff talk and how business is going to shift, at least in the eyes of the consumer. Mattel is not going to make Barbie dolls and Hot Wheels and stuff like that for any cheaper because of the tax tariffs. And so the price of Barbie is going up, I just want to tell people. But she's a pretty special doll. It's not like you're buying something at the, nothing wrong with Dollar General or, Dollar Tree. But I'm just saying. That's what the president said.
You can just get the knockoff. It's fine.
The knockoff Barbie?
Yeah.
Well, you better talk to Kulhanek. He's got 3 daughters.
Is there like a Temu Barbie, or what are we talking about here?
Temu?
Well, like the American Girl doll, we always just did the knockoffs, and it's totally fine. Those things are crazy expensive. They don't know any different.
Yeah.
Yeah, well, especially when they're little, of course, yeah. Yeah. All right, fine. No Barbie talk here on this segment. How about the holistic planning for retirement segment that we have prepared, and all 3 of us have access to those notes? Let's go there. Health, happiness, purpose, they should put this into the wedding vows from now on. Don't you think? Do you promise to invest with your health, happiness, and purpose in mind, not just your portfolio? I do.
You do.
Yeah.
So I think maybe we should have had Jeremy on this show. I think, is he the Barbie expert? I'm disappointing the audience here. I'm not sure, but
I don't know.
I guess if you're talking about health, we talk about financial health, we talk about your physical health, your emotional health, your psychological health. The thing that I would always remind people of is having a plan for what you're going to do with your time and not sacrificing opportunities. So as part of as a holistic planning firm, if you understand what that really means, first of all, because a lot of these terms like fiduciary and comprehensive planning and all this stuff gets thrown around. What the heck does that mean? How does that help me? I work with so-and-so. How is that different than what they do? And so if you just, if you're driving, maybe have somebody next to you they do this for you, but draw a triangle on a piece of paper and then separate it into thirds, right? Almost like the food pyramid.
All right.
So your base is chocolates and candies and sweets and So the base, that's where you want to write the word product provider, okay? And so these are the different ways that you can interact with the financial services industry. So product provider, what they're designed to do is give you a window to the financial capital markets, so that way you can make an investment and you can do really simple stuff like buy a mutual fund, or you can do really complex stuff like trade, options contracts and all kinds of fancy, more high-end stuff. It's designed to be a low barrier to entry. You can use firms like Vanguard, Schwab, Fidelity, Robinhood, Betterment, SoFi, E-Trade. The list goes on, right? Mm-hmm. And it should be low fee in the sense that you're probably not paying, you don't have an advisor, so you're not paying anybody for advice.
Okay.
Pros and cons, hey, low barrier to entry. There's usually like little to no for minimums. I don't have to have $500,000, or $1 million if it's, Kingfisher or whatever. But I don't get any guidance at the same time. So if I call in, if I have a question, I can call in, and they're going to give me, we're not fiduciaries, advisors to you. We're simply here to provide a service. We can give you general information, but we can't provide you with specific advice.
Okay.
Tier 2 is what I call asset managers. And asset managers are designed a little bit differently. And this is where most, I'd say, FAs or financial advisors, this is kind of the water they swim in. And this is where, for the majority of our existence, we also were located. I think Jeff would probably agree with that. There was an evolution over time of the firm. But like kind of at the beginning, we were like, well, shoot, we've got these pretty sweet tactical investment strategies that, are going to totally do better than what you have. So it was that common conversation you get when you go to meet with a financial advisor. They say, I'm going to do this comprehensive review, but most of the discussion is over investments. Like, hey, you've got a standard deviation on your portfolio is 17.9%. And for your asset allocation, that's actually about 1.5 times what I would recommend, because the delta here and the alpha, and they start throwing out all these, like Greek terms that you're just like, your eyes glaze over.
Yes.
But at the end of the day, they're like, but you're getting 7%. We could have got you 8%. So let's just do this transfer and call it a day. And there's more to it than that. Like, they're going to build out an investment portfolio for you, and you're going to have semi-annual reviews or annual reviews. And I'm not saying there's anything wrong with it, because that's what we were doing. But I think for retirees, with all the uncertainty of what's going to happen with tax policy and the changes from the Secure Act and what RMDs mean and the different like key retirement ages. We've actually got a retiree important date calendar that we'll send you when you give us a call. And Jackie will give you the number here in a second, but call in and just request that calendar so some really key dates that you need to be aware of. A lot of people don't realize 59.5 is a key date. For those folks who want to make sure they have more control over their investment decisions and they don't like the options within their 401k, 59.5 could be an absolute game changer for you, because that's the typical age at which you have the potential to do like what's called an in-service rollover, where you can take more ownership of what you have and what you're investing in. 62 is a key age, 65, so on and so forth. But as holistic planners, we think that we just need to be able to be on top of this more and spend more time focusing on a plan than what investment products we're putting inside your portfolio. Of course, we can do that. We're licensed financial advisors. We've done that for years. But that's the top of that triangle, holistic planning, where we're going to look at all 5 key areas. And I kind of give the example or the analogy of, product provider. That's kind of like if you could use a medical analogy, because all of us, have been to the doctor at some point in our lives. Product provider might be like, you just go online and you use Dr. Google, and that can be scary at times. But you just kind of, do a search to figure out, I got this shoulder issue, and I'm going to see if I can figure out what's going on. The the asset manager, that's like going to your general practitioner, right? They're going to be able to check you out, take your blood pressure, maybe draw some blood, take an x-ray. But if it's something beyond that, like you need, a stent put in or an ablation or something like that, you're probably going to go to a specialist, somebody who is focused on just doing that. In the world of financial planning, what Stonebridge is a specialist in the area of retirement planning, retirement income planning. So that's really where our kind of specialty lies. And again, you can get that calendar when you give us a call.
Here's the number, 866-295-5146. Call Stonebridge Wealth Systems. Request your calendar. Request your strategy session, 866-295-5146.
As Americans, we strive for better. From a better house to a better career to a better life for our children and grandchildren. Better has become the American way. When it comes to your retirement, what does better mean to you? Does it mean more income, a flexible lifestyle, better solutions? A better retirement begins with a financial plan. To get your complimentary written financial plan, call the number you see here. You only retire once. This is your opportunity to plan for better.
going to be talking about a bit of a trade deal, if you will. Thank you very much for having us on. This is the Retirement Compass Radio Show with Stonebridge. Wealth Systems, reachable at 866-295-5146. Call Stonebridge if you'd like to get some information on your retirement, on your business, on retiring your business. It's 866-295-5146. I was noticing that there's a trade agreement to that effect between the UK and the US. Does this involve our farmers here in Nebraska?
Word is that it will. And I mean, we're still in the early innings of this thing. You know, it's interesting, Jackie. I think it was probably beginning of April. Maybe it was even late March when there was all this tariff talk taking place. And you'd asked the question, you said, well, are we going to have a resolution to this or something along those lines? And I said, listen, I think that from the research I've done, I think we're still in kind of the first or second inning of this thing. Like there's going to be a period of negotiation. And it could be a year from now before this is finally kind of settling down. And I don't know that for sure. It's just that I feel like these things tend to be like a slow moving cargo ship. They don't like turn on a dime. It ain't, a fancy speedboat. As far as this deal between the U.S. and U.K., it sounds like some trade barriers have been kind of slashed or reduced, at least to some degree. Before, I think that the UK had, according to online sources, something like a 9.2% average tariff on U.S. ag products. So that could be corn or soybeans. And some things, like I say ag products, that's a pretty general term.
It could be beef.
Beef, poultry, and dairy. Some tariffs, it says, were as high as 125%. Now, again, our farmers are going to know a lot more about this than what I do because it's it's the water they swim in. It's the world that they navigate day in and day out. But from the sounds of things and what the president has said and the Treasury Secretary, they've come to an agreement with the UK. I don't think it's finalized by any stretch of the imagination that will reduce some of not only those tariff barriers, but also some of what we call the NTBs or non-trade barriers, which could be like onerous regulatory requirements to be able to export. Like, you can't use the GMO or you can't have any hormones or something like that in the beef that you're exporting. And the U.S. has long said that some of those things were unfair. The way that they were designed was to kind of single out the United States that our FDA had considered, safe, that they said, no, it's not. Now, some of those things obviously raise a little bit of a red flag from a health safety standard. But, that's why you got to make sure that, if you're thinking about it from a perspective of, hey, there's this balance between too much and too little regulation. You don't want none at all. You think about some of the books that you read back when you're in high school and some of the processing plants that they go into, and it was just a disaster, right? Obviously, there's a place for that, but you also want to make sure that it's not just such thick red tape that that is inflationary in and of itself, or it can be if you add too much overly burdensome regulation. So at the end of the day, it's opening up maybe a broader market or a larger market. And I think part of the calculus is, hey, we don't want to be as reliant on China because China is a big customer, if you will, for U.S. ag products. If we can find other customers outside of just China, it's going to ease the burden, I think, on the farmers here. And the reality is, ag is a huge portion of the GDP of the state of Nebraska, if you will, if you think about it that way. I don't know exactly how much it is, over 10% for sure, I would say. It's a very large portion of what we do.
Right. Now, that's very interesting and helpful, especially for the ethanol and beef. I was just reading as you were speaking, 866-295-5146 to call Stonebridge Wealth Systems. You would like to book a sit down and say, hey, I'm going to retire or I'm going to sell some of this land. I'm going to need your help on all of these strategies to do with my taxes. Call Stonebridge, 866-295-5146. 866-295-5146.
The work never seems to end until the day it finally does. After nearly a lifetime on the job, you should be rewarded for all the time you spent working. Whether that's crossing off items on your bucket list, learning a new passion, or rekindling the love of an old one. After all, life isn't over when you stop working. It's the start of an all-new chapter. The one where you're the writer and you get to choose how your story will go. A way to achieve that is by having a clear financial plan to sustain your golden years. The biggest fear most retirees have is if they'll have enough money to maintain the lifestyle they've always enjoyed. Having a plan to help protect you against the curveballs life often throws will help to maintain your lifestyle. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
Retirement Compass Radio Show with Stonebridge Wealth Systems, getting you to where you want to go. I like that. That's one of your slogans there, Tim Kulhanek in the Lincoln office. But if you're just tuning into the show for the first time, they're happy to help you all the way across the Midwest with some very experienced advisors, a great team of people who are working to secure you in your retirement, to get you to and through your retirement years without checking statements. We talked a lot about that in the opening segment and in last week's show, didn't we? Because that is not a fun retirement, having to look at a statement to see if you guys are going to buy a car or go on vacation.
Yeah, I mean, that's why, a lot of people, they think that, well, we might be able to retire, but we'll have to just sit and watch the grass grow. We won't be able to do anything. We'll have to radically change our lifestyle. And, that's not a very fun feeling to have.
No.
They felt that, the only way they'll be able to go on vacation is if I just continue to work, and then I'll have some time off that I can use the money that I've accumulated through my 9 to 5. But what we found is, in this meeting I had just the other night, this is what we found is guys, we can build in a budget for travel. So when we're doing planning, we don't just say, hey, you can retire, but don't spend more than this amount.
Don't go anywhere.
Don't do anything. So, I had a guy in the other morning, and he said, well, Tim, how much can I spend? I'm looking for, and he goes, well, I listened to your show, so I'm looking for a license to spend.
Yay!
And I was just like, good. Yes. Awesome. Oh, kind of like from old school. Yes.
Yes.
So I said, well, let's look at that, because if we look at the withdrawal rate you're at right now, it's like 2.7% of your overall portfolio. And, what's a safe withdrawal rate? There's a debate going on about that pretty much at all times. I think somewhere around 4% is probably still a pretty good rule of thumb. 8% if you're Dave Ramsey and you get 12% annualized linear returns. But, for the rest of us, 4% is probably a pretty good target. And I said, in a dollar amount, that's an extra $30,000 above what you're taking now. And shoot, so we can spend more and we don't have to worry about running out of money. I go, listen, I don't know how you're going to spend your money. You're going to have more of a problem. This is for a lot of people.
Yes.
Because a lot of it is psychological. We tell folks it's a rational response to the unknown. The rational response is, I don't know how long I'm going to live. Mm-hmm. I don't know if I'm going to need some sort of health assistance or long-term care. My mom did, and it was $9,000 a month, and it was just a nightmare. It was so expensive. And so I don't want to spend any money because what if I need... But the thing of it is, that's where this license to spend comes in, where we're going to make sure that we're using strategies that give you the confidence to spend month in, month out, year in, year out, and plan those trips. Because if we do a good job of creating a base, a good foundation, so make sure we maximize your Social Security, we help you get your debt paid off before you retire if possible, then we maximize your Social Security for both your lifetime and that of your spouse if you're married. We optimize the efficiency of your investment portfolio, so you're keeping more money in your pocket rather than growing both your money and the government's.
Oh.
And then we make sure that we're investing in such a way that when those market drawdowns, we talked about the top of the show, the economic recessions and bear markets and all that fun stuff, those are cyclical. It doesn't mean that they only happen at certain points in time. It means that they happen on a recurring frequency. And so when those things happen, we want to make sure we have a plan, building a solid, in some sort of volatility buffer. So he said, well, show me the buckets though. He said, I want to see the buckets. How much do I have in those 3 buckets? And we use different bucket systems. So there's the tax buckets, but what he was referring to is the risk buckets. So he said, all right, how much do I have in safety? That's like money in the bank. And ideally with the safety bucket, that's going to be something that's designed to be like 6 months of your expenses should always be in that safety bucket. And you're maybe targeting like a 1 to 3% return in that money. It's not designed for growth. That's not the point of it. It's, hey, if things go bad, if I lose my job, I'm not going to find a new one. If I got to replace something like life's consistent inconsistencies. Couple came in. Well, we thought we were done spending money for a while, but then the water heater went out, and I had to get new tires on my car. Like that, of course, those things are going to happen. So that's your safety bucket. Then you've got the income bucket, and I also call that growth without risk, because the idea is it's either going to provide you a guaranteed income every single year, so guaranteed lifetime income, so you can have peace of mind and feel that you are secure in your retirement. Again, handing you that license to spend because it's money that you can't outlive. That's one strategy. I used to not be a real big believer in those like lifetime income type strategies. It's saying that sounds weird, right? Like when you hear yourself, the words that are coming out of your mouth. I used to not be a believer in being able to draw an income for the rest of your life, right? But like it's because you typically use either a pension, annuity, or you're delaying Social Security till age 70. And a lot of people are like, well, I don't know if I'm going to live to 70, or I don't know if I'll live long enough to get the break-even point's 82. But what we've found in practice is people will spend more money and enjoy retirement, and therefore have a higher satisfaction from a lifestyle perspective in retirement if they have some amount of money that they know that they can rely on. So whether that's a income strategy, or that's why I call it growth without risk, where it's something that when the market goes down, you have a place to go to draw money out of, so that the money that was at risk in our third bucket, growth with risk, that money is going to fluctuate a lot more. And so we're going to have to wait for that to come back up. Well, that's why we've got this middle bucket. So the middle bucket, you're probably targeting a return of 4 to 6%. Could do better. It could be a little bit under, but that's pretty good range. And then in that growth bucket, you're probably targeting a return of 7% or more. Again, I'd love to sit here and be like, you're targeting annualized return of 15%, but I don't, I'm not on Sirius XM. That's where they can give all those, sky high, pie in the sky numbers, which, buyer beware. I've seen plenty of investments that have made very, very appealing promises like that, and I'd say more often than not they don't actually pan out. Sometimes you're lucky to get your money back.
Right.
We want to be realistic, but I showed him his 3 buckets, and you know what, Jackie? I think he left here not only feeling more confident, but like he looked excited to be able to go home and be like, "Hey, look, we're in really good shape." And I printed off an update for him to show him how they're doing so far this year. And again, because of the way that the media works and they're more focused on, it's a lot easier to get people's attention and control people if you tell them everything's bad. Because if you tell people everything, like, no, things are actually, you're doing okay and things are going fine, people tend to think that you are lying to them, right? Or you're making something up. And that's not good, it's harder to, like, they're suspicious of you, if you will.
Yes.
So, when he left here, I think he was like, you know what, we're going to go home and book another trip. I don't know. And that's where we want to be with our clients, is to give them the confidence, that license to spend. And ultimately that's the result that we're seeing.
I'm so glad that he was listening to the radio show. Did he mention your fantastic co-host that gave him the phone number, 866-295-5146, 866-295-5146?
He didn't say anything about Jeff, no.
Oh, my gosh. Call Stonebridge Wealth Systems. See if you can get that feel-good sit-down. Well, you can get the sit-down, and I bet you're doing, that's a funny thing to say, but I bet you're doing a lot better than you think you are. And most people just, they watch the news and they hear from their neighbors, I cannot retire. I have so many people, like my neighbors. I cannot retire. We cannot. I go, don't you have a 401k? Don't you have a pension?
Have
don't
you ever tested it? Like most people, it's all in their mind that they say that. But it's not based off of anything objective.
Right.
And we want to take the abstract, right, the theoretical, and let's make it concrete. Like, let's give something that's constructive that says, okay, maybe you can't, but maybe you can in a couple of years. And here's how we're going to get there. Let's put a plan together. So,
right. By the way, this is the Retirement Compass radio show with Stonebridge, and we got a couple minutes left. Tim, I was going to ask you about some tax loss harvesting. Do you have any of that going on in the office right now?
Yeah, well, it's planting season, but so I don't want to be confusing to anyone here. We are
sorry.
It's
Wrong
always
harvest.
time to harvest here. So again, I give this example. regularly. I've got a client who lives in South Florida, Deerfield Beach, and most of his money is in brokerage accounts. So like some people call it a taxable account. That's the term we use, or cash account. It's money that's taxable every single year. So if you get an interest payment, you get a 1099. If you get a dividend, 1099, right? And so what we're trying to target is when he needs money, hey, got to put gutters and a new roof on the house.
Right.
So I need $20,000 or whatever it is. I try to target, hey, I'm going to get you the money you need. We're going to harvest a few gains, right? And we're going to offset those with harvesting a few losses from things that haven't done as well.
Oh.
And so, like, I looked at his account the other day, and he has realized gains this year, which they're going to have to pay taxes on. I'm going to make up a number, actually. Let's just say it was $15,000. Well, let's say that he had some stocks that he had purchased years ago, and or maybe we had purchased them that just they're down, right? They've just had a tough time. They haven't worked out. You're not going to get them all right. Good news is in our field, you got to get more than half of them right, and that's it, So I can sell some of those things, right? Realize the loss, and it's going to offset the gain that he realized. So if I could offset, let's say that he's in the 12% bracket, and I want to keep him in the 12% bracket because if he had the $15,000 in gains, that would push him into 22% bracket. He's going to start paying taxes on his capital gains because even though the brackets are now separate, I'm generalizing here, roughly if you're in the 12% income tax bracket, that means you're in the 0% capital gains tax bracket. So what I did is I said, you know what? Okay, I can't have $15,000 in gains this year. You're going to start paying tax, and then we don't like taxes, right? It's your money. Use it when you need it, right?
Yes.
So what I did is I identified some positions that I could sell at a loss that are going to offset those gains, that are going to move him back into the 12% bracket, so he'll be able to get all the money he needs, all $20,000, and even more than that from his previous distributions, and there'll be no tax liability whatsoever. That's tax loss harvesting. And then, like, if you want to take it a step further, if like you want to buy back into the thing that lost money, you can't do that right away because there's something called a wash sale, which basically would disregard that, because a lot of people probably heard me say that and they're like, oh yeah, and then you just buy it right back. No, you can't do that. You can't buy anything. You can't buy the same position with a stock or an ETF or something that's what we call substantially similar. Unfortunately, that's pretty vague, and the IRS kind of gets a say on that. But we can reposition maybe for 30 days, and then on the 31st day, we go back in, and if we want that same position, we reinvest in that, and we're kind of made whole, if you will.
Great. Make yourself whole. That's why the bridge is made out of stone. It's going to keep up. It's going to hold up. Call Stonebridge Wealth Systems, 866-295-5146. 866-295-5146.
Did you ever think your retirement would be shared with our government? It's true. Your traditional 401k, IRA, pension, or similar retirement accounts are like a partnership with the IRS. Simply put, they want their tax dollars, and you have them. With our latest tax calculator, you can plug in your own numbers while sitting at home. To find out what your future tax liability could be, scan the QR code or go to stonebridgetaxbill.com.
Hey, welcome back to the show. This is the Retirement Compass Radio Show, and we've got Stonebridge in the house. Jackie Selby on this side. I have Tim Kulhanek in the Lincoln office, and that's where you are sometimes. But you guys move around between that, the Kearney office. We got John in Grand Island. He holds things down pretty well there. What about Jeremy? Where's he these days?
Jeremy is like, man, he's all over the place.
That's what I thought.
He's the rover.
All right, let's talk about some scenarios from our body of listeners. I mean, it's all the way across the Midwest, so I kind of put together a couple of scenarios for you. Are you ready, Tim?
Let's go. Shoot.
Okay. The new tariffs are hitting imports. Prices on everyday goods are creeping up, and folks are worried about higher cost of living. And they're worried, everyone is, that this is going to eat into their fixed income. How could rising tariffs affect someone's retirement plan? And should they be adjusting their inflation assumptions right now? Wow.
Good question. Probably a little bit too early to tell. Tariffs do tend to cause prices to go up. Just specifically, though, it's typically on the items that are tariffed. It's a little bit different than more generalized systematic inflation, where you see a general rise in the prices of every good and service. So, for example, in 2022, when we were told repeatedly that the inflation was transitory, but it lasted for a long time, you saw a general rise in prices where the consumer price index, CPI-U, rose as much as 9% year over year when it peaked there in like mid-2022. Tariffs, though, it depends on how broad they are. So if they can make deals with a lot of the major trading partners of the United States, we're hopeful that this is maybe a glass half full approach, that it can be offset. The big thing tariffs do, though, in this trade negotiation, trade war that's been kicked off has created is uncertainty. And the market really, really, really doesn't like uncertainty. So how can it affect your retirement? Market volatility, number one. We've seen that already this year. Don't get complacent. A lot of people will point to where the market's at as of this recording is almost back to even for the year. And they're like, well, see, there's nothing to worry about. It was just, a
blip.
BTD, buy the dip is what people will say. Not specific advice. Mileage may vary. Maybe it is, but maybe there's continued volatility. I was at a presentation from a large global financial services firm out in California a couple weeks ago, and their presentation essentially said, hey, look, tariffs are going to be a major shakeup, and we expect continued volatility for the foreseeable future. So, again, don't get complacent. So, number one, market volatility. Number two, prices on some of the things that you like to spend money on could go up. Now, that could be offset by changes in economic production. It could be offset by a slowdown in the general economy, which can cause deflation, which is confusingly not a good thing because it means that people are probably being laid off and there's just not as much economic activity because demand has collapsed. But at the end of the day, so number two is prices could go up. You can call it inflation. It doesn't make a difference to me. It's more expensive to buy certain things. Number three, though, is just kind of what it does to people psychologically, and so how could it affect your retirement? You might be more prone to extend working because with this, now I can't retire. I was going to retire. Now I can't. We're going to go on vacation. Now we can't. And that's probably the number one reason why I'd encourage people to reach out is because I've heard that from people. I heard that from somebody that was sitting in the conference room that I'm looking at right now. And they said, well, there's no way I'm going to be retired now, with these tariffs. And I ran a report for them, and it was the same thing. It's such a common occurrence that people come in. It's no, you're in good shape. Yes, you can retire. You can keep working if you want to, but I'm telling you can retire when you want to on your terms. But do we need to make a few tweaks to your plan? Yeah, but does it need an engine overhaul? Probably not. Some people maybe, but let's just start doing the basics. KISS. Keep it simple, Sally.
Here's the phone number.
Answer?
Yeah, that's a very good answer.
Okay.
Call Stonebridge 866-295-5146. It does start with lifting the hood. You got to pull over to the side of the road, right? You got to lift the hood up and have a peek underneath to see whether you do need a whole new transmission or not. And probably not 866-295-5146. The other part about that is fixed income. I noticed that came up in this particular scenario. Fixed income. Why do they say it's fixed? Because they don't know if their money is going to grow. Is that what that means?
It's because what's the opposite of fixed?
Variable.
Broken.
Oh.
So you don't want broken income. Okay.
Right.
We're getting real deep.
Wow.
Fixed income in the sense that there's two different ways that you can grow your money. Okay. You can grow it. Well, there's three, we'll say. Because one is kind of a blend of the two. One is capital appreciation. I buy something for $10, it goes to $11. That's capital appreciation, the price went up. Two is yield, right? So I buy something for $10, it pays me $1. The price didn't go up, it stays at $10, but I still have the same amount, right? In both cases, I've got $11 now. 10% yield or 10% capital appreciation. Fixed income instruments, think of bonds. The basic premise of a bond, which is a loan to, could be a corporation, could be government, could be local, could be, we call that municipal bond, could be federal, which we call a treasury bond. I loan this company, let's say, with a corporate bond, investment grade corporate bond, $10,000. They're going to pay me 5%. That's my yield. So it's a fixed income payment, a fixed payment. We call that a coupon. They're going to pay me, let's just say it's semi-annual coupons. So if it's 8% per year, I'm going to get 4% every 6 months. And then at the end of the term, or the duration, if you will, you could call it tenor. There's different, kind of nomenclature we can put in there. It's basically semantics. If it's a 5-year bond, at the end of 5 years, they pay me my principal back. So do I have more money? No, I still have my $5,000. I got fixed income, okay? CDs could be categorized as fixed income. Our structured note program is categorized, for the most part, as fixed income, right? You're designed it's designed to provide a set amount of payment that you're going to receive. Does that make sense?
Yeah. It makes a lot of sense, actually, because I feel like people who say they're on a fixed income, they're not growing their money. It sounds like a dour prediction to me.
Well, but like to that point though, like this is where there's some nuance, because maybe we're not talking the exact same thing.
It's okay.
Because from an investment perspective, that's fixed income. But if somebody says I'm on a fixed income,
right, it
more means like I'm not working anymore. So I'm like, if I'm on Social Security, it's a fixed amount. It's not variable. My pay, if I'm, a trailer salesperson at the local dealership, like my pay is variable. And if I want to increase my pay, I got to sell more trailers. I got to sell more ATVs. Yes. I got to sell more pickup trucks. My dad was a car salesman for like 20 years before he retired. And so that's not fixed income. It changes. It fluctuates. If you retire and you're on Social Security and let's say a pension, it's a fixed amount. As I call it, like a pension is also known as a defined benefit plan.
All
They're
right.
defining how much benefit you're going to get. And so you're on a fixed income. It's like I can only, but where the variable piece comes in, and this goes back to like that whole planning, comprehensive, holistic approach, is like I had a couple in here the other day, and they both have Social Security. They both have pensions from the state of Nebraska. So like their base income, right, before they get out of bed from those two things is basically $100,000. Okay. So they're going to make $100,000. Everything's paid off like before they do anything. So that doesn't include though, like their 401ks, IRAs, 403bs, brokerage accounts. And so what we had a discussion of was, well, like, because they were thinking, well, we need to pull back, right? We need to stop because there's tariffs and that sort of thing. And I said, guys, like, let's just shift where you're taking your money from. So we shifted from bucket 3. Remember what that was called,
Yes.
Jackie?
No.
Growth with risk.
Growth with risk. I can't
Not
say that
lisp.
fast. I know I cannot say
Growth
that fast.
with lisp? Is that what that was?
Growth
with risk to growth without risk. Because I'm like, hey, guess what, guys? This is why we did this. Like, it's part of the plan. This isn't like, oh my gosh, the market went down. Like, no, I'm on my 15th year here. That it does happen. Like I started in 2010, so I was on the tail end of the 2008 debacle, right? That was pretty fresh on most people's minds. We went quite a few years. Like 2015 was pretty troublesome because it was really bumpy. 2011 or 12, there was bumps, but no major declines. But in 2018, there was a bear market that occurred in December of 2018. 2020, the pandemic, crazy time, right? 35% decline, fastest drop of 30% or more in history. 2022, slow, drawn out, kind of year-long bear market, because kind of painful. And then 2025, the tariff thing. So, like, no, these things happen. You got to remind people that this is kind of a feature, not a bug of the market. But we've planned for it. And once I was able to explain that to them, I think they felt a lot better. And like we mission accomplished. By the time they left, I said, no, we're gonna turn these distributions back on. We're just gonna send them from a different location that's principal protected, that you don't have to worry about like locking in losses or selling at a loss or anything like that.
I love it. And so did they kiss? Because they were so happy?
No. Were they supposed to?
No, not you and them.
No, I know. No, they did not. No, I said, were they supposed to?
I don't know. I just wonder do you see any kissing in the office from time to time, I guess?
I've seen it before, but it's usually just the one time when you tell people like, hey, you can retire whatever you want to. If you want to retire this year, cool, let's do it. If you want to retire 3-4 years from now, it's not going to look worse.
I love it. And then you get the arms thrown around one another and the kiss. All right. To get the kiss, I don't know what I'm reaching for. I'm just kidding. 866-295-5146, 866-295-5146. Call Stonebridge to get the kiss effect. How about that instead of just the...
Keeping it simple, Sally effect.
Right. Fine. It's 866-295-5146. That was great. That was fun. Give me my music. Yeah.
It's the outro, yo. The show's over. Time to go home.
Oh, man.
Gotta go home, okay?
Gotta have some
Can't
fun,
stay
though.
here, but you don't gotta go home.